Hello, this is part 5 of 6 of corporate level strategy. Let's talk a little bit about unrelated diversification. In one of the earlier segments, I mentioned Berkshire Hathaway, which is run by a man named Warren Buffett, who's typically among the wealthiest people on the planet in America. He plays bridge with Bill Gates, etc. He's actually agreed to leave most of his wealth to the Gates Foundation to be spent within 20 or 30 years of his demise, so it's not going to become a foundation in perpetuity. But what does he do? He is the master of unrelated diversification. In other words, he goes in and buys firms from all manner of businesses. And what is it that these new firms gain as an advantage? Well, they get corporate parenting and restructuring. This is where the positive aspects of being part of the Berkshire Hathaway family outweigh the loss of autonomy. During the late 80s, we saw something called the phenomena called the barbarians at the gates, and that's where these people would come in, these corporations, buy a firm, break it up, and sell off its constituent parts for more than they were worth as a collective. And this was a form of corporate parenting that was negative in many aspects, but made many people quite wealthy. Corporate restructuring. This is the intervention of the corporate office into a new business or an old business, an existing business, to change its assets, capital structure, or management. Specifically, corporate management must have insight to detect undervalued companies. And again, I mentioned, in the 80s, people would go in and say that the firm as a whole was undervalued, but if we broke it up, its parts would exceed that value. And you must have the requisite skills and resources to turn the business around. Turnaround management's a very challenging industry, and you've seen it done successfully. General Motors is a recent example. It can involve changes in assets, capital, and management. We'll go into that in greater length here in a moment. People like Warren Buffett have a portfolio of goods. And what are they doing? They're assessing the competitive position of the portfolio of business within a corporation. So they see if some things are cash cows, and we'll talk about these later, they want to balance part of that with riskier, higher growth potential sorts of business. And that suggests strategic alternatives. And it also will help us identify priorities for allocations. In your own life, as you manage your stock portfolio, for those of you who are under 30, you probably ought to be heavily invested in the stock market. It's high risk, high return, but over the long term it tends to average out and yield higher returns than, say, being in the bond market. Versus somebody like myself, when you get around 50, it's time to start balancing the risk, in other words, reducing the amount of stock and increasing in other forms of investment in your portfolio. The Boston Consulting Group, BCG Portfolio Matrix. This is fairly famous and ripe for testing sorts of items, and this is something that you should familiarize yourself with at great length. In the upper left-hand quadrant, we see stars. These are the businesses that have a growth rate in excess of 10% and their market share is relatively high. A few years, well, the big ones are Google in the tech industry. For many years, Toyota would have been in there. We might actually say that somebody like Kia in the auto industry is a question mark. In other words, they have high industry growth rate. Can they move in the market share to that high end? Remains to be seen. Cash cows. These are stable businesses that have big market share. They tend to have lower return on investment or relative market share. Or excuse me, the relative market share is still high, but their return on investment or growth rate is relatively modest. In other words, the market's fully developed and saturated. therefore not a lot's going on. Dogs, these are industries where you have relatively little market power and the growth rate of the industry are both in the lower domains. One example of this is actually the rail industry. For many years was considered to be something of a dog. However, our friend Warren Buffett, who we've discussed, has made quite a bit of money, unbeknownst to people. If you buy enough of it, it moves into the cash cow very quickly. And lastly, the question marks. The big question mark is it sustainable? They're having a big growth rate. Is it a fad? So here's an example. Church & Dwight has a well-balanced portfolio of products, which includes Arm & Hammer, baking soda. This is baking soda, sort of stuff you put in your refrigerator or use to clean your sink. Trojan condoms, enough said about that. OxyClean, you see the ads on television. AIM toothpaste, First Response, Nair, which is a hair removal product, Extra laundry detergent, and Brillo scrubbing pads. Most of these are household items, if you would, that can be purchased at a single source, your grocery store, for example. So they benefit by having distribution chains that are going to the same markets. What do portfolio managers do? They allocate resources. They find attractive firms. These are the people who go out and do the valuation. You should get a lot of this in your finance and accounting courses. They provide financial resources, often termed venture capital. You might learn about this in entrepreneurship. Provide high quality review and coaching for units. These people will go in and actually tell you how to turn your business around and help you develop strategic goals, etc. So what are some of the limits of this? SBUs, these are strategic business units, are generally only compared on the two dimensions you saw on the BCG matrix. And they're often viewed as standalone entities. In other words, we're not trying to create the synergy that we talked about in normal mergers. To this extent, the management becomes largely mechanical. Did you meet your numbers is the big question. If you failed to meet your numbers, something bad's going to happen to you, hence the strict rules about resource allocation. All right, that concludes part 5 of 6. I'll join you in just a minute to wrap this up. Thank you.